Buddy Robert Bonavito here, New Jersey forensic accountant. Today's topic is going to be on investment fraud, and this is going to be a little bit different fraud than you're typically used to talking about, because most people, when they think of fraud, they think like, Bernie Madoff, Ponzi scheme. We all know what a Ponzi scheme is, right? You attract more investors, and the old investors, when they ask for distributions, you pay them out of the new investors, and the only way it usually gets caught is when too many people ask for too much money at one time, and that's what happened to Bernie. But that's simple fraud. This is more insidious, and you really have to think deep to understand it. But this is a type of fraud large companies like CNBC, when they have investment people on talking about investments. Now, those people are relying on audited financial statements to discuss the company, right? But what you don't know is how they've done. How have their investments done? How you're taking advice from this guy who's very clever, but has he outperformed the market? Has he outperformed the S&P 500? Is there audited information on him? There isn't. So that, it can really be exemplified by Warren Buffett's bet. And again, you've probably heard of this. He had $1 million bet with some really, really smart people, Protégé Partners. And the bet basically was that he will just invest in the S&P 500 fund, and these real smart people at the hedge fund will invest how they normally invest. And after 10 years, we'll see who won. Now, obviously, Protégé Partners charges all kind of fees, and it takes a lot of your time if you're investing, because you got to watch what they're doing. S&P 500 fund basically do nothing. So not only, obviously, Protégé Partners got crushed. The return from Warren was over 7, and the hedge fund earned 2.2. And this is typically. Now, if you met these people, you say, wow, these guys are brilliant, making lots of money, but they're not making money. And that's the fraudulent part, because if you put your money with these guys 10 years ago, right, and you're getting all these statements, you're meeting with them, and they're like, oh, our returns are great, they're going up and down, and then you have your friend next door who invested in a low-cost S&P 500 fund, no worries, nothing. And that's where this fraud comes into being played. Now, I don't know about fraud in this, but that's the example of what we're talking about. Now, there's some key lessons here. Low cost matters, right? S&P 500 fund, low cost. Efficient markets. Now, that's the efficient market theory, where a stock price reflects everything that's known about that stock at that time. Now, this is where a lot of these experts they say, well, that's impossible. Of course it's impossible, but over the long term, the efficient market works. On the short term, there's some questions. This is really for long-term investing. You can get somebody who's very lucky and outperform the market for a year or two, but it's not going to happen consistently for most people. And this is the really interesting part, is that a novice can outperform a 40-year veteran. You take the best people in finance who've done investments over 40 years and study it consistently. The guy who doesn't even know what an investment is can outperform them by going into a long-term, low-cost S&P 500 fund. You don't know more about taxes than your CPA. You don't know more about your lawyer than your lawyer. You don't know more about yourself than your doctor. But investments you do. And I'm talking about the top guys. You can outperform them. And this is where we run into fraud. This is the type of fraud we typically deal with in our firm. Okay, the first one is unsuitable investments. And again, if you say here, it's, advising clients to invest in high-fee, low-cost products that predictably underperform S&P 500 funds. This happens all the time. People don't know they're underperforming markets. They think their investment guys are the greatest, but that's because they never compare their performance to the S&P 500. The second type we do is negligence or breach of fiduciary duty. Again, this is pretty straightforward, right? You manage a portfolio, but it's consistently underperforming indices. Now, why are you doing this? Why don't you call the client and say, listen, you're better off investing in an indice rather than with me? This never, ever happens. The third type is index hugging and active fees. Now, this one here, this is basically, they charge fees despite offering worse returns than the index it's supposed to outperform. We just saw that with the Buffett bet, right? And, you get to talk to all these smart people. They take all your time, and meanwhile, they're getting crushed by the S&P 500 fund. And that's a fraud. It can be a fraud, depending on how it's done. This one is funny, the infinity. This happens all the time where you have someone who's an ethnic, of the same ethnic group going to his, hey, so-and-so, he's one of us. You should put your investment money with him. And you do that, and then he's like, well, we earned 7%. Meanwhile, the S&P 500 did 32%, but he never tells you that. And this happens a lot with even religious groups. Everybody uses the same guy in a synagogue or the church for their investments. And then they find out that, hey, listen, I would have had 3 times as much money if I just didn't listen to your advice and went with the S&P 500 fund. But people trust them, and they take advantage of that trust. And again, this is a ton of our work. We have a case in-house with the biggest firm in the country, and we're going to take them apart because they did something similar to, the hugging. It was hundreds of millions of dollars in a trust. And they would meet with the trustees every 3 months and give them these huge reports. Guess what wasn't in the report? It didn't say how the investment was doing compared to the indices. Always underperformed the indices. Had all kinds of economic analysis and beta analysis, written by very smart people, but it missed the most critical part. And we're going to talk about a company that actually does report the right way at the end of the video. You may want to stick around for that. But those are the 4 types of fraud we like to deal with, okay? And the numbers are usually staggering. Now, how do these professional, these guys do it? How do they, why do they think they can beat the efficient market theory? And there's basically 2 methods, or 3 if you combine both. But a lot of people, what we call the firm foundation theory, which is basically fundamental analysis. This is where they analyze the company, predict discount rates, and value the company. The problem is a lot of bias goes into those projections. And the same guy can look at the same company and come up with totally different projections based on what numbers they use. So this is really not, it makes you think hard about the investment, but the answer is always wrong. Okay, that's what I tell people. But it's useful to do fundamental analysis, and we do it a lot. But the answer is always wrong. The second one is castles in the eye theory. This is basically technical analysis, and this was really developed by John Maynard Keynes. And what it does is based on psychological. Okay, people are buying stocks, and if you chart stock prices or indices, you can figure out what's going to happen next. Now, obviously, like I said, this is basically castles in the air theory, and anybody can look at those charts. So what is it really giving you, especially now with AI? Again, so a lot of people like to combine both, which, I think this is probably smart. And again, the weaknesses in both of these theories outweigh putting a lot of money there. It's fun if you want to do it as a hobby, but if you want to make money, just disregard this. Look at the S&P 500 funds. Now, and this is the key, studies show that over the long term, 94% underperform the S&P 500. So this means all these brilliant guys you see on television and the radio, and they underperform. Now, when the market's going up, they're doing great, but they're not saying, hey, I made 25%. But guess what? The S&P 500 made 28%, and you don't have to listen to me. So that's the real fraud there. I mean, it can be fraud. Now, many consumers, they don't realize that the investment's underperforming. They don't know. I talk to people all the time, and I'm not going to tell them. It's not my place to say, listen, you're wasting your money. But if they ask me to do analysis, I will, and they may sue whoever's doing their investments. But because they're looking at my return of 12% or 13%, which is half of what the S&P 500 did, or, obviously sometimes they're going to beat it's long term that we're talking about. So they don't even know. They have no clue. Okay, and CNBC, obviously, the guys come on here. They're brilliant. They're smart, and they argue, and they have all these great reasons why the stock's going up and down. I don't want to know that. I want to know how you've done in the past. I want an audited statement like you rely upon in those companies. And if it's not if the audit's not real, or there's a problem with it, we could sue you, just like you could sue that company if you're relying. That's what I want to see. So they should really flash up instead of all this BS they flash. We don't own it. My family doesn't own the stock. Say, here's how much money I made last year in my funds I manage. Here's the indices. I outperformed to underperform. Obviously, most of them are going to underperform, and that's why they don't do it. That's a fraud. So, there is obviously some ways that I think that, with low beta stocks and leverage stuff that you can consistently outperform the markets, but we're not going to get into that here. But let me just show you how it should be done This is what I like to see everybody who comes on television have. And this is, like an investor shareholder report from Janus Henderson. This is a technology fund. And this is what every investment advisor should have. And you can see like this, they talk about, this is the letter. Here's how much it would cost for a $10,000 investment. Here's our fee, which is, points. That's not bad, but, typically this should be, 1/10 or 0.3%. But, it's a managed fund, so there's more expenses. They talk about performance period, and here they say right here, the S&P returned 36%. They're saying they did 40, which is, far better. But their indice where they compare with the actual type of that invest in the same did 48. So, but this is great information. And they say, who's our top performer? Okay. Who's their top performer? Well, let's see. Meta Platforms. Okay, Meta. Who is their biggest loss? Well, let's see. Wow, it said Nike. I don't know, but they didn't do. I'm surprised. But anyway, so they talk about, which is great, right? Hey, we did some good things. We did some bad things. Here's the key. Okay, they're saying if you invested $10,000 in 2014, here, okay, you would have like 50,000, well, 60,000 here, which is the Janus fund. Okay, this global, the index, the real indice is about the same, so that's good. And S&P 500 is lower. And you can see here, this is great. Okay, for 1 year we did 49%, S&P did 36, 48. 5 year we did 20. So every year they're outperforming the S&P 500 fund, but the one that they really go up against is this one here because it's the same. It's a technology index, and you could see that they underperformed it by a little bit, but over 10 years they did. This is what you should see now. So here's another one here that I like. I mean, it's the same company, but they basically give you the same information, and this is what when you see a guy on one of these shows. They should have a statement like this, at least this part. This is a growth and income fund. And you can see here, again, I like this company because they give you the information. Here you can see that they're underperforming every single time by a little bit. But at least you know. And so many people look at their investments and they're not making any money. So anyway, guys, this is a little bit long, this video, but it's a very important talk. These last two sheets are critical. Listen, if you guys have any questions, just leave a comment. Me or one of my associates will get back to you. Thanks for listening to the video.